What's up, everybody? Joe Brown here. This is the Heresy Financial Show, and everything is collapsing everywhere you look. Stocks are falling. Many stocks in all the major indices are down 60, 70, 80, 90%, especially with some of the tech stocks from their all-time highs just within the last 2 years. And the major indices now are falling as there have been a few big names keeping the whole index up, and now they are starting to fall as well. And so looking around at stocks and seeing everything go down everywhere we look, the question is, how do I know what to buy? How do I know where to allocate my money? So in this video, I'm going to give you a few tips and tricks that I use in order to find value when everything is crashing. Some strategies and tactics that I use to find stocks, to pick the stocks to invest in when it looks like everything is not a good investment, everything is bad investment. That is never true. There is always a long somewhere. And in this video, I'm going to show you how. Ready? Let's dive in. This video is sponsored by STRPF Mining, but more on that later. All right, so the first thing that we are going to look at in terms of how do you find value when everything is crashing is going to be something called top-down investing. So there are two different approaches to investing in general. You've got top-down and you've got bottom-up. We're going to look at both of these because I use kind of a Frankenstein combination of both of these things. So top-down investing is the first one we're going to look at, and this is exactly what it sounds like. We're going to look at the broadest things happening in the world first and drill down looking for investment opportunities from there. If we look at Investopedia definition of top-down investing, it's an approach, an analysis approach that focuses on macro factors of the economy like GDP, employment, taxation, interest rates before examining micro factors such as specific sectors or companies. So the number one thing that's happening all over the world right now is going to be looking at monetary policy. So monetary policy right now is one we're moving into tightening. We're seeing all around the world interest rates are being hiked. We're seeing quantitative tightening where central banks are selling assets. That puts downward pressure on asset prices. They're withdrawing money out of circulation. That contracts the money supply. Very different environment than we saw, let's say, 2 years ago when all central banks were doing the exact opposite with monetary policy. So we're not seeing money being injected into the global economy. We're seeing money withdrawn. We're not seeing asset prices being supported. We're seeing asset prices being pushed down, including debt prices. We're not seeing interest rates being suppressed. We're seeing interest rates start to be pushed up. Very different environment, which means that the economic impact of that is very different as well. And so instead of asset prices like stocks being supported, this is not a growth environment, this is a decline environment. In the United States during the first quarter, we saw GDP contract for the first quarter. We are currently in that second quarter, and it looks very much like we are going to have this quarter be a contracting GDP as well, which means we are in a recession. Again, not a growth environment, this is a decline environment. So that's monetary policy. So then you wonder, okay, well, what is the economic impact of that? And this is where we have to look at the strategies that big money uses to deploy money in these environments and where big money shifts. And really what you see is during these high growth environments, everything goes into things like tech, more of the speculative things, because it's like, hey, there's a lot of money, a lot of growth. Everybody's throwing money on all these different projects to see something that might hit like a lottery ticket in the future. And so things get priced with really frothy and high valuations. Everything is making money. Everybody wants to make money. Everybody starts piling money in everywhere. We're in the exact opposite environment of that right now, where it's like, I don't want to speculate at all. I'm going to pour my money into the sure bets, the things with cash flow, the things that people will always buy no matter what. And so we start to get into environments where people are, we're looking at things like real estate. People always have to have somewhere to live, and real estate has still performed stellar to this day. We're looking at things like commodities, because commodities, raw materials, steel, things that people need to make all the things that people will still buy, those prices are going to be supported. We're looking at materials, we're looking at commodities, we're looking at food, we're looking at water. Again, all of the basic needs that people need to survive, those are the things that do exceptionally well compared to everything else during these low growth or decline environments versus what we saw like 2 years ago when it was all the speculative stuff doing extremely well. The other portion of top down is going to be looking at government regulations. And the other big thing we see everywhere in the world right now is a big push towards green. We are seeing regulations. We're seeing energy costs skyrocket, which means that people are going to be searching for other ways for getting transportation that's cheaper. Go out and ask your friends and say, hey, are you considering buying an electric car right now? Do you think that that would be nice? Are you considering buying a hybrid right now? More people than ever are thinking, man, the more pain at the pump, the more likely I am to buy a hybrid or an electric car, because then I don't have to worry about those prices at least as much. And so not only because of high energy prices are consumers being pushed to EVs and hybrids, but we're also seeing regulatory pushes. Look at all of the new big SUVs, the Sequoias that Toyota is making. They're all hybrids. Look at their new trucks. Most of them are hybrids. Look at all the cars that Ford and all the GM companies, GMC, Chevy, all of them that they're putting out, they're all moving towards hybrids and electric. And so this is not a free market thing happening. This is all around the world. Governments are pushing regulations that are saying, hey, the entire fleet needs to get better and better and better gas mileage. And the only ways that they can do this is to move towards more battery tech, even if it's not a full EV, hybrids in their cars. And so we're seeing this is a big macro push, a big top-down thing. We're seeing more of a demand for those things that are going to be needed to make those shifts. So we're going to get into that in a little bit. And that's why at this point, I usually stop top-down investing and I go and start looking at some of the bottom-up factors. So let's go to bottom-up and see what bottom-up is. Bottom-up is an investment approach that focuses on analyzing individual stocks and de-emphasizes the significance of macroeconomic and market cycles. Focuses on a company's fundamentals like revenue and earnings, not the overall economy. Bottom-up investing is basically looking specifically at the company and disregarding everything else. And that's why I like doing top down first, because that gives me a general idea of where to look. And then I use bottom up to find the specific companies. And an example of what we're doing here is imagine you've got a box, and this is a magic money box. And every year this box prints out a $100 bill for you. If it prints a $100 bill for you every year, how much would you pay to buy that box? That's the question. Would you pay $1? Of course you'd pay $1, because no matter what the inflation rate is, that box will print out $100 for you every year. There's almost no way that's not going to provide a positive ROI for you. You would absolutely pay $1 to get $100 every year. So you're going to do that. So you know this box is definitely worth at least $1. Would you pay $100 for this box though? Well, then you might have to take a step back and you think, okay, well, I might pay $100, but if the inflation rate gets really high, then it might take 2 years for me to make back my return on a inflation adjusted basis. Maybe it takes 3 years for me to make back my investment. So you're looking at how much that $100 per year is actually worth to you in terms of giving up $100 now in order to get that. So you might still look at that and say, yeah, it's definitely worth $100 now. But is it worth $1,000? Would you pay $1,000 for that box? Well, now then you have to really think about it and think, okay, well, what are the chances that inflation comes down to a point where I get a positive return on my money after 10 years? Because with zero inflation, it takes 10 years for me to get my investment back. So maybe it takes, with inflation at the current pace, 15 years, 20 years. Then you're like, man, I really don't know. And then you also have to take into account the fact that you might not have that box forever. What if something happens to it? What if it breaks? What if it gets stolen from you? And so you're looking at all these factors and you're saying, okay, I'm going to pay this much to get back this much. Now you might be thinking, well, most stocks don't pay dividends these days, and that's true, but there's other ways to get your money back to be returned to shareholders, because that's all stocks are. They're just a magic money box. And the question is, how much am I willing to pay for the chances that I get that money back or more money back than that in the future? So you're looking at a stock that is profitable or has the chances to be profitable in the future, and they're either going to use that to pay dividends to return capital to shareholders, or that company might use that to buy back shares to push the price of the shares up to give shareholders a way to sell their shares at a higher price, because now you've got new investors as well saying, hey, there's a higher likelihood that they get their money back at some point in the future. And so it gives the early shareholders a way out and a way to get their return on their capital. So it's just a box that prints money money, and you have to ask yourself, how much am I willing to pay for that box? That's bottom-up investing. And so ideally, you want to find a box that is printing the most amount of money possible, while at the same time, whoever's selling that box is selling it for a really low price. You want to be able to buy that box that's printing $100 a year. You want to be able to buy it for $1. And it might be one of those things where it says, okay, we're pretty sure this box will print $100 in a year or in 2 years. And so that's why you can buy it for $1, because it's not guaranteed. And so this is where I'm going to give you an example of a company that fits the top-down approach and the bottom-up approach here of finding value when everything is crashing, and that is STRPF Mining. Now, STRPF Mining, number one, yes, I own this stock. So is that me talking my book? Absolutely. Of course it's me talking my book. Otherwise there'd be no skin in the game. If you have an opinion on something but you have no position, that opinion's pretty much worthless. And so I don't talk about individual stocks on this channel unless I own them. And again, they are sponsoring this video. Let's take a look at some of the fundamentals of STRPF Mining, because this is a great company. So number one here, we have to see what is the price of this stock. So many people just look at the price per share at the time of this recording, 81 cents. But the real price, you have to look at the market capitalization, $34 million. So big note of caution here. This is a very small stock. Many of you are wealthy, credited investors. If you go out and you throw a few $100,000 into this, $1 million into this, you will jack the price right up. There is not enough volume on this for you to throw a massive amount of money into this without it spiking the price, because there's just not a lot of volume. So the market makers are going to take a look at large orders and they're going to say, we're not going to sell that. There's not enough shares available at 80 cents. We'll fill you at $1. We'll fill you at $1.50. And so people will get filled at higher and higher prices. But then the market price comes right back down to where it was, because now you were the only buyer up at those prices. So now the next buyer behind you is wanting to buy it back down at the same price that it was being bought and sold at before. And so big word of caution on any stocks that have a really low market cap. You've got to drip into them. You've got to buy little bits at a time, buy them when they're dipping, buy them when they're getting sold off. You can't go in and throw a large order in, because the price will jack up and then drop right back down. That's just market mechanics for illiquid securities. So STRPF Mining is worth right now $34 million. That's 81 cents per share. So what is STRPF Mining and why do I like this company? Let's take a look at this map. This map is the Abitibi Greenstone Belt. This is a very good region for finding metal. So we can see here, there's a mine here called the Noor Metal Mine. There's this mine here, the Red Star, which is the new metal mine. And within walking distance, I'll look at this other map here. We can see a Perron property owned by Amex. Now, this Perron property owned by Amex has taken this company sky high. This is important to note. The share price of that company exploded because of the gold that property found. And that's important. It's just gold that they found. But in this STRPF mine, they found not only gold, but silver and zinc and copper. This qualifies STRPF as a VMS deposit, of which there are only 350 ever discovered in Canada. This one's in Canada. And VMS deposits account for the majority of these metals that are produced. Now, remember what I said earlier about top-down approach to investing? We have to look at the monetary policy environment that pushes investment into the real needs. Well, materials and commodities fit into that. We have to look at the regulatory environment. Big push for EVs and hybrids and green technology. These metals, copper, zinc, silver, fit into that. Absolutely big, huge discovery here. STRPF has drilled 90,000 meters versus the other company's property within walking distance, drilled up to 300,000 meters, and STRPF is already hitting 9 out of 10 holes. They say the best place to find metal is where metal has already been found. And the best part about this is that STRPF owns another property right next door, back on this map, called the Noor Metal Mine. The Noor Metal Mine is a past producing mine that STRPF now owns, and they haven't done anything with it yet. But past producing mines from like 100 years ago, what people used to do to mine for gold and silver, they would literally pick it up off the ground. Because if there wasn't enough gold and silver to literally pick it up off the ground and use a hammer and a chisel to get it, it, then you couldn't get enough out of it to make it profitable. But now we have all sorts of technology where we can see into the ground and drill in the areas where we know it's deeper, where they were just drilling blind back in the past. And we have much more modern technologies to extract that precious metal out of the ore. And so we are able to make profitable a lot of deposits that didn't used to be profitable 100 years ago that were just left behind. And that looks like what STRPF is sitting on with that Normetal mine, again, right next door. And so STRPF has this property that they're drilling on right now that is sandwiched right in between something that exploded in price, exploded in value just from gold, and STRPF is sitting on a VMS deposit, which is gold and silver and copper and zinc, right between, on the other side, something that used to produce massively like 100 years ago. And the best part of this whole thing is the team, the insiders. So this goes back to some of the bottom up things that you look for. And so if we look at some of who the insiders are, we first find that in this company, Amex, the founder of this company that again exploded in price because of just the gold, moved over to STRPF. He's their chief geologist now, and he's a shareholder. So between him, the founder, Jonathan Moore, insiders and investors own 40% of this company. That's a big ownership stake, and they're not selling. And Jonathan Moore said he doesn't think this company is worth selling at anything below $5 per share. Take a look at the chart right now. As of the time of this recording, it's 81 cents per share. Now I want to point something out here. You might look at this and think, it has gone down a lot, and it went up to $3 a share and it went down from there. So what caused this? Right around this time when it was $3 per share, there was a forced exercise of a bunch of warrants that were at 75 cents. And so they didn't want this potential dilution sitting out there. They were forced to exercise. So a lot of investors were flush with these shares now that they own these shares at 75 cents a share, and now it's sitting at $3. So a lot of selling happened, which drove the price down. That's good. That means it's already happened. That flush out has happened, which means it's selling at a discount now. And again, insider ownership is still 40% unwilling to sell at anything below $5. And that's the key here. They want to develop this. They want it to sell to a big boy, a big investor, big company that comes along and scoops it up to start producing, because that's what these VMS deposits are for, is to produce. And so they want to get this ready. They want to sell the whole company so that any investors who piled in at these low prices are rewarded. Any investors who bought that money box at $1 with the expectation that in the future it would be producing $100, that they get the reward that they were looking for. So like I said earlier, companies like this, these are big risk. You have a lot of volatility here. You pile a lot of money in, you buy it up, and then it drops right back down. So be careful if you're looking to buy in this at all. This is a company I own, and it is not investment advice. This is an example of the way that I use top down, bottom up to find value in markets like the ones we are in today. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.